It's time for the Your Personal Bank Show with Ferenc Toth, president and founder of Secure Estate Management. Take charge of your financial future with your personal bank. Now, here's Ferenc Toth.
Welcome to Your Personal Bank Show. We've got some exciting stuff to cover today. And, I just want to kind of reiterate some things we covered in recently. The previous show was we talked about things, the positive arbitrage by using insurance contracts along with a banking tool, a line of credit, to get a positive arbitrage and earn positive interest on your money while you're still using it for other purposes like paying off debt or purchasing items or investing in other things. And I guess that really brings me down to the key point is I get asked this all the time. This is a personal bank show. What is your personal bank? And like I said, from a high level standpoint, really it's a financial concept, and the idea is to strategically integrate specific financial tools from the banking and the insurance industries. And what we're doing is we're creating growth on funds, okay, even when you access them for other purposes. See, here's the biggest challenge that clients and folks just deal with on a regular basis is when you're putting money away. And you're putting money away for the future, and often for many reasons. I mean, we can talk about college and retirement or, whatever it may be, starting businesses or any other purpose for that matter. But when we're putting money away for the future, particularly retirement, the dilemma becomes when we have a need for monies or we see an opportunity for those monies, the dilemma is, well, do I take the money from the current investment and reallocate it to this new investment or pay off this debt or do these other purposes or needs for money or not? And the dilemma that's there is as we all know, when you take money out of an account, out of any kind of investment account for that matter, the growth on that is reduced, because if you take a portion of that money or all of that money, for example, you're not going to have growth on that money going forward, or less growth on that money going forward because there's less money there. And the problem that causes is it conflicts with real life. In many cases, it often does. Life happens. And, with COVID, for example, is a recent reminder of how the, incomes can be affected, businesses can be affected dramatically in very short periods of time. Investment accounts can wildly fluctuate in value. Volatility picks up very quickly and unexpectedly, and things happen. And it doesn't even have to be an economic situation that cause. It can be a personal situation, a person's life or their family. Health issues occur, job losses, business losses occur. Things happen in life. And when those things occur and you have a need for funds, often, again, it's like, do you rob the goose that's laying the golden eggs? You know what I'm saying? If you kill the goose, it can't lay eggs anymore. And so you have an immediate need or a short-term need that sometimes overrides your long-term needs. And it's an either-or proposition. And that's what we find often in most cases in people's lives. I mean, that's just real life. Do I take the money now or leave it there for the future? Well, by using your personal bank and combining the bank and insurance tools together with a synergy, using the synergy to enhance the results, you actually can access funds if and when you need them and still earn positive interest or growth going forward. And I'm going to discuss this a little further as we go forward and understand how this can go. And by the way, the other thing I want to point out is a lot of people have the mistaken notion that you have to use a low growth type of safety insurance account. Like, a lot of people talk about whole life contracts and things like that. That's not necessarily true. Although that is a commonly used tool, it's not the only tool. We have a growth factor tool that enhance growth that basically can grow up to 2.7-fold, 2.7 times whatever index it's credited in. The S&P 500 index is the most common. We use international indexes and various things like that also. But the bottom line is with that tool, using a quick example, I'm going to go into more depth about this as we go forward. But using that tool, you can see, for example, a 10% return on an S&P 500 in a given year. With that factor enhancer, your return 2.7 would be 27%. You would see a 27% credit in your account that year. There is a fee against it. You take the fee off of it, which happens to be 7.5. The fee is basically what they're doing is they're buying options to enhance the results. But the bottom line is your return that year would be 27 minus the 7.5 fee. Or in other words, 19.5%. And what did the index do? It went up 10. You nearly doubled the return of the S&P 500 index. Oh, by the way, you also have a floor. In other words, the company guarantees the downside. Okay? And by guaranteeing that downside, the principal being guaranteed, I should say, there's no market risk to the downside. So if the market is flat or goes down, you don't lose money. You do still have the fee, so the potential risk there, the downside risk is that 7.5%. So as I talk to people and say, look, you want to see growth, often double the market returns, the index, whatever indexes you're dealing with a floor, knowing you can't do worse than 7.5. That's appealing to a lot of folks, and we can incorporate the personal bank concept with this by using the banking tool. And here's where some light bulbs are going to come on. Here's the thing. You can actually access funds through the line of credit on these type of accounts. And the current rates on these are like 3.95. So if your account's going up more than that, guess what? You've got a positive arbitrage scenario going on, don't you? And I want to talk about this more and how this goes. But like I said, the how to do this is the first step in creating the personal bank and creating the positive arbitrage, having access to your money and allowing the money to continue to grow while you're using it for other purposes. The first step is, frankly, setting up a high cash value policy. And really, these are policies that are designed to maximize cash growth on a tax-favored basis, okay? These are not the insurance policies most people are familiar with, okay? Most people think of insurance as a death benefit protection tool strictly. And here's what I want to say about that. If you have death benefit protection needs, as I do, I have family, I have a business, take care of those needs. By all means, certainly do so. And if you have some of those needs, be happy to talk to you about them and how to take care of them on the most cost-effective manner. But what the personal bank is really focused on in these types of policies, again, these are the type of policies that are, typically, gosh, I'll tell you what, we see 60 to 90% available cash day one. Depending on how you structure it, okay, and it'll increase to over 100% within a few years typically. And you can grow the funds, on a tax-deferred basis. And here's the interesting part. If you access them through the line of credit, as I was stating before, and if you access those funds and you're using it for a business purpose, then often the interest on that loan becomes a tax deduction. So on one hand, you're growing the money tax deferred within the policy, and then on the other hand, you're accessing those funds, for example, a business purpose to expand business, start a business, whatever that may be. A lot of real estate investors use this as a tool. And as a legitimate business expense, now that interest becomes a deduction. Quite interesting how all this works. And as I pointed out, very high cash value available at the beginning and every year going forward. If you have one of these policies, if you have a policy, let's say, and you have cash value in it, I can tell you real quickly if it's designed to maximize cash or not, is over half the monies you contribute going towards cash. You want at least that, if not much more, depending on the situation. You see, there's a lot of folks out there, and I see it often, and it's sad. They think they've purchased a personal bank type policy like we're talking about that's designed to maximize cash. And then I look at the contract or I look at the illustration, and often there's little or even zero cash in the first year, sometimes several years, and they think they're maximizing the capability of growing cash. Here's the fact, they're not. That's a sad fact. I'm going to show you and share with you how you can know the difference. And again, contact us at yourpersonalbank.com, but stay tuned in the next segment. I'm going to help you share and know how you're going to know the difference if you're really maximizing cash growth, and then how using the bank line of credit can give you a positive arbitrage on your money. Stay tuned.
For more information on Your Personal Bank, call Ference at 866-515-6280 or online at yourpersonalbank.com. Back to Your Personal Bank Show with President and Founder of Secure Estate Management, Ference Toth.
Welcome back to Your Personal Bank Show. We've been talking about, well, what is your personal bank and how does it work? Well, it's really quite simple. Again, it's a financial concept that what we're doing is combining strategically the synergy of a bank product, a bank financial tool, with an insurance financial tool. This is not about death benefit protection, although that is a portion of what's available. Our goal is to maximize cash growth. We use high cash value policies. These policies often have anywhere from 60 to, I've seen 90% cash available day one. And that is their, again, and then every year, cash growth maximized going forward. These policies, these are designed to grow cash. They grow it on a tax-favored basis. The money grows tax-deferred. And the thing is, by the way, it gets over 100%, liquid cash, usually within a few years in most cases, okay? Again, it depends on how we structure it in your situation, of course, but that's how it's done. And then the second piece is then we establish a line of credit with a bank, and the policy is used as collateral. Now, here's the thing. You can't just go to any bank and do this. They don't offer this type of line of credit. It's a specialized type of banking tool that's offered only by, frankly, a handful of banks around the country that I'm aware of. I've worked with and strategically aligned with several of them, the best ones that offering the best rates and the best programs. And by the way, if you didn't hear previous show, I recommend go to yourpersonalbank.com, where I interviewed Brandon Miller with M&M Bank about this line of credit, using these bank line of credits to create the positive arbitrage. Now, what is positive arbitrage? Really, it's quite simple. You're earning more. On one hand, the policy is earning more than the cost of the loan, the line of credit, the interest on the loan. Therefore, if you access funds, you're accessing it from the line of credit. The money is still in the policy. So it's going to grow. It's going to do its thing, whatever it's going to do. The line of credit, you access it from there, and the difference, there's a difference. You're earning more than you're getting charged. That's positive arbitrage. What did you do with the money? Again, as we shared before in previous shows, the money most often is used for business purposes, which if it is, then it can become the interest on that loan can become tax deductible. Starting up businesses, real estate investment, but I've seen them for all kinds of purposes. In lieu of refinancing, fixing up homes, college, weddings, emergency funds, anything you can pretty much think of, these funds are used for. There's really no restriction on those funds to use them. And again, those funds are still earning interest or growing in most cases while you're using them for these other purposes, which, by the way, is real life. Remember what I said in the first segment? If you didn't hear it, recommend going to yourpersonalbank.com and check it out. The dilemma with most financial or investment account, any type of investment, is when you have a need short term for the money and you're trying to grow it long term, when you have the short term need outweigh the long term need and you take funds from it, those funds basically stop growing because they're no longer there. You've taken it. And so your long term returns are then reduced, aren't they? And that's the dilemma that all of us face in life when we're talking about investing money for the long term. This allows you, here's the difference. You can continue to grow your money where it's at or using a policy to grow it. And you can access those monies and often, in most cases, still earn a positive return on those dollars. That's the difference, okay? So again, this line of credit, by the way, typically in most cases, there's no loan fees. The interest is, by the way, is only charged when the funds are being used. I often recommend to my clients that, they'll say, well, I don't need the money right now. I don't see a need for it. I want the money just to grow. No problem. Set up the line of credit anyway. Why? Well, things happen. Opportunities occur. Emergencies happen. And if you have one of these line of credits set up and established, there's no cost to do it. There's no cost to maintain it. It just sits there. It's money available to you. It's a lot of the times the same philosophy of why people get HELOCs on their homes. It's not necessarily because they need the money. It's a reserve. It's an emergency fund. It's an opportunity fund. It's easy access to funds if and when something comes across. And so, again, I often recommend clients to get HELOCs on their homes because, again, there's no cost, there's no fee. Money's available if and when you need it. The advantage of here, even in my opinion, the things that make the equity line against the insurance contract even better is these insurance policies have underlying guarantees. The principal is guaranteed, okay? Whichever type we choose, whether we choose the fixed eddy, consistent, steady growth option, or if we choose the performance factor option where it grows, up to 2.7 times of the index that is credited in, which is typically the S&P 500. You can see tremendous upside growth there with, again, the principal being guaranteed, so you have some downside protection, okay? Here's the thing. If your underlying asset has principal guarantees, so it's not going to lose value, in other words, and you have a line of credit against it, you don't have that risk of getting underwater, of borrowing more than the asset's worth. In 08, 09, unfortunately, a lot of people got caught with that with real estate, where they borrowed against their properties, and the property value dropped below what they owed, and they become underwater. Many of us are familiar, remember that situation. And when they got underwater, bad stuff happened. Loans got called. The bank, in many cases, there was just a lot of bad stuff happen. Well, if your underlying asset doesn't lose value, you don't have that risk. So that's why I tell most of my clients, in most cases, you set up this equity line, you set up this line of credit against the policy. The policy has underlying guarantees, so it doesn't lose value. That's your primary source of funds. By the way, the current rate's 3.95. And we foresee that existing for the next several years because the Federal Reserve has come out and stated they're not going to change. They're keeping the interest rates low until the end of 2022 at least, which means not much is going to happen and change in that regard. So you're going to have that positive arbitrage scenario in most cases. And guess what? The underlying asset isn't going to lose value, so you don't have to worry about getting underwater on your loan. All right? So that's kind of a nice thing. And again, as I stated, if it's used for business purposes, the interest on that loan can be a tax deduction, okay? So obviously talk to your tax person, but we find that to be often, applicable. So the bottom line is this. When the owner accesses funds through the line of credit, remember, you're accessing through the line, not the policy, the insurance policy. The funds are increasing faster in the policy most often than what you're getting charged. You get the difference. You gain the difference. And remember, what did you do with the money? Well, that's up to you. It's your money. You control it. You got checkbook access and all that. You can access and use it for however. Now, I'm not going to recommend you just go and blow it. Don't get me wrong. But if you take advantage of opportunities, business expansion, business startups, real estate investing, those are some of the most common uses we see of it. But again, if you want to purchase a vehicle or remodel a kitchen or any of those kinds of scenarios, or you want to put money away for or you need to pay for a college or weddings or any of these other big expense items that happen in our lives, well, guess what? You have a choice. You can take those funds and purchase those items or invest in those things or pay off debt, of course. And that money, if you took it from an account that was earning, stops earning, that money stops earning now. Or you can set it up with the policy and the line of credit and still earn some interest on that money that you spent on a wedding, for example, or retirement, or college, or anything else for that matter. This is why we get so excited about it. When I share this idea with clients and people that first look at it, when the light bulb comes on, there's a genuine excitement about realizing, wow, I can have my money grow. I can have my money continue to grow. I can still access and use my money, and it'll still grow. That's a pretty darn good combination. We're going to talk about this a little bit further, how this works and how you can maximize your growth with the performance factor. You can either choose the steady, eddy, consistent growth. You can choose the performance growth or some of both. Stay tuned.
For more information on your personal bank, call Ference at 866-515-6280 or online at yourpersonalbank.com. Back to Your Personal Bank Show with President and Founder of Secure Estate Management, Ference Toth.
Welcome back to the Your Personal Bank Show. We're talking about a lot of exciting stuff today. Really, what I'm talking about is what is your personal bank from a big picture standpoint. And really, it is about combining. It's a strategic alliance, a synergy of using banking financial tools and insurance financing tools to grow your money, grow it consistently, or take on, grow market type returns, have some downside floors, have some guarantees, have some tax benefits. But here's what's most important. Have access and use of your dollars and still earn interest on those dollars most often while you're using them elsewhere. See, that's the paradigm shift in thinking that I get, and the light bulb that comes on for folks as I talk to them about this. It gets pretty exciting when you really consider what that can do for you, especially over the rest of your life, your lifetime. See, again, as I spoke in the first segment, what's the dilemma we all face when it comes to investing our money, and then especially if we're trying to invest for the long term, and then short-term needs or opportunities present themselves? Do we take now what the short-term needs or desires are to away from the long-term future, or do we keep it in the long term? It's an either-or proposition, because when you take money out of a typical investment account of any kind, for that matter, any type of investment, the growth on that money stops because you took it and used it elsewhere. Okay? So if you're using it for another investment, it's like, should I do this investment or that investment? Which one's going to give me the better return? And then there's risk factors involved and tax consequences and all those things that have to come into play to make that decision, one or the other. Or if you're going to take that money out to pay a bill or pay debt or purchase an item or whatever that may be, or pay for college or weddings or anything else for that matter, there's that dilemma about, well, how much of that do I take away from my long-term future? Because when I take that money and I pay for that college, or I pay for this, or buy this car, or do whatever it is you do, you understand the growth on that money just disappeared. It stopped for the rest of your life. And if you understand compound interest, and you think about things in terms of a decade, 2 or longer, that can be significant. What your personal bank does is it allows you to not have to make that decision of now versus the future. In other words, you can take monies now, still earn interest and growth on those monies now, and not negatively impact your future so much. Here's what I mean. So, again, we're using a banking tool and we're using an insurance tool to make this happen. And what we're doing is we take a high cash value policy. It's a policy that most people are not familiar with. It's designed to grow cash primarily. Not so much, there is a death benefit, but that's a secondary concern. We're maximizing cash growth. And if you want to know if you've got a cash growth type policy, I can tell you the secret. It's real simple. At least more than half of the monies that you're contributing starting day one needs to be going to cash. Often we have these cases where we're going from 60 upwards to 90% cash day one. If you look at an illustration or you look at your policy or you're considering one and you have a big fat zero in your cash year one, I can tell you it's not designed to maximize cash. It's not structured that way. What it is it's designed to have a bigger death benefit. Now, is that a bad thing? The answer is not necessarily. Again, what are the needs? What are your needs? What are your goals? One of the questions I ask people all the time is, are you trying to maximize death benefit or are you trying to maximize cash? What's your goal? What's your purpose? What are you trying to accomplish here? Or could be, are you trying to do some of both? See, one of the big pet peeves we have out there, and one of my challenges is when I say to people insurance, they don't, most of the time, in many cases I should say, don't understand really what I mean. In other words, they have a preconceived notion in their mind of what insurance is. It's a death benefit protection tool. And many people I run into look at it as that strictly, in that view or that lens. And the real problem is there's often folks have death benefit protection needs, and by all means, certainly you should take care of those, as I have. But they also want to grow cash. So there's a teeter-totter, if you will. If you think of it, there's a teeter-totter of cash on one side, death benefit protection on the other. How much of the money do we allocate to one side of that teeter-totter versus the other? Now, there's some limitations how far we can go with it on each side. It's based on the Modified Endowment Contract, or MEC rule, which is a tax rule that's been around since the 80s. But there's quite a wide range of how we can adjust that teeter-totter. And anybody who has a negative perception or says something negative, oh, you don't want to do that because it's insurance, or insurance is a bad investment, and those kinds of things, what they're missing, here's what they're missing. I'm going to tell you, share a little secret of the industry. Here's what they're missing. And unfortunately, some just don't listen, but that's okay. Hopefully you're listening to the show. You're one of those that wants to learn. you're one of the coachable, teachable folks, and that's who I love to work with. What they're missing is this. They are looking at a contract, most often cases where there's a negative response in terms of growth, it's a bad investment, all that kind of stuff. They're looking at a tool that's not designed to maximize cash growth. In fact, in many cases I see it, it's designed to the opposite. It's designed to maximize death benefit and minimize cash growth. There may be a little bit there, but it's not designed for that. Or it could be a hybrid. It's trying to accomplish two goals at the same time, which we can do. Has some death benefit protection goals with some cash growth goals. And experts and financial advisors, it's rampant out there. You can look it up online. It's insurance is a bad investment. Well, they don't understand. They don't know the goals of that policy. They don't know the purpose of that policy. And what I find is not uncommon that the insurance agent probably set it up correctly for the needs of that client. But an advisor, a financial expert, whatever, looks at this policy strictly from a growth-focused lens. In other words, they're thinking strictly growth, nothing else. And they say, well, other investments can get a better return. So therefore, it's a bad investment. Well, from that growth perspective lens strictly, they're correct. But what they don't realize is the goal, the purpose for that policy was not to maximize growth. It was to accomplish more than one thing, or it was designed to maximize death benefit, not cash growth. And then insurance agents are accused of, taking advantage of clients or doing the wrong thing or whatever it may be, and frankly, the insurance agent was doing the right thing for the client. That's the most common misconception in the financial industry that I run into. And I have run into that for decades. What I'm trying to do, my goal here with this Personal Bank show and everywhere I speak, workshops, meeting with individual clients, whatever it may be, and by the way, lately it's been webinars, obviously, is to help educate people and help them understand and ask them the question, what's your focus? Are you trying to maximize death benefit? Are you trying to maximize cash? Are you trying to accomplish some of both? Let's find the right mix for you. And by the way, the majority of my clients are interested primarily in growing cash, or the vast majority of it. Well, guess what? Your Personal Bank tool fits that bill. And by bringing in the bank line of credit, where the interest charges typically in most cases are less than what they're earning, means they create a positive arbitrage. They earn more than they're getting charged when they access the funds. And they often, again, for business purposes, get tax deductions on top of it. Therefore, their money is growing. And then when they access their money, it's still growing based on the difference of what they're earning versus what they're getting charged, but it's still growing. That's the difference, okay? And again, when you're going to borrow against an asset, this line of credit with the bank, remember the funds are still, you're dealing with two tools. The funds are still in the policy. This is groundbreaking information for a lot of folks. The second most common comment I get all the time is, why haven't I ever heard of this before? We're going to talk about that in the next segment, and I'll share with you probably why you haven't heard it. And you know what? Here it is, so check it out. It's worth checking out. Stay tuned in the next segment.
For more information on Your Personal Bank, call Ference at 866-515-6280 or online at yourpersonalbank.com. Back to Your Personal Bank Show with President and Founder of Secure Estate Management, Ference Toth.
Welcome back to Your Personal Bank Show. We're rounding third. We've been talking about a lot of great stuff today. We've been talking about really what the Your Personal Bank concept is. Again, using a bank and insurance financial tools combined to create synergy strategically to enhance returns, tax benefits, and most importantly, still earn interest or growth on your money even when you're accessing those funds for other purposes. And here's the thing. Here's something I'm going to say to you. This line of credit, again, the collateral for the loan is the policy, the funds, the cash in the policy, okay? You want to put the funds in the policy and let it grow and do its thing, whether it's a fixed option, steady, consistent growth every year, or whether we're using the performance factor growth. where we're earning up to 2.7 times the index. For example, an S&P 500 index that earns 10% in a year would get a 27% credit. There's a fee of 7.5 that's used to purchase the options and stuff to create the factor. Those of you understand how that works. So your net return that year would be 19.5, and the index went up 10. That's powerful upside growth. Its potential is tremendous. The downside is if the markets don't do anything, they're flat or go down, the principal is guaranteed. So you have some downside protection. You still would have the fee, so you'd have a 7.5% loss that given year. That's your floor. That's your downside. So tremendous upside protection. Most cases I see often double the index returns on the good upside years, and protections limited a floor on the down years of 7.5. If that's a good fit for you, and it is for a lot of our clients, that's a tremendous option. And then when we add in, and by the way, what's the threshold on that? One of the considerations when you determine should I do the growth performance factor versus the steady Eddie consistent, which is right now 5% currently, every year guaranteed, 4% contract guarantee, by the way. So that's a steady Eddie consistent no matter what. Or should I look at the performance factor? Well, if the threshold with the markets, let's say it's the S&P 500, again, that's the most common index that we use. We have some international options and various others. But if it's, if you're high threes, about 4, if you over 4%, you've overcome the cost, the fees, because remember, it's a factor. So even if, the market only went up, say 3%, you're still getting credited 2.7 times that minus the fee. So the threshold is actually about 4%. Little less. So if the markets are going to average over 4%, the index, we'll say the S&P 500 index, averages over that, over 4%, you're ahead of the ballgame. You're going to have a positive return on the performance growth factor. Okay? It's that simple. So if that's of interest, let me know. Now, here's the thing. When folks are waffling, should I do the consistent steady Eddie or the performance? Well, the statements I make all the time is no reason you have to do all of one or all the other. We can mix it up. We can do a mix of both, okay? Having some kids, I've talked about this for quite years, actually, in workshops and on the radio now, about having some consistent steady Eddie is wise, but also having some growth potential is wise. And having a mix of both, for most people, is probably the best fit. But everyone's different, and we can talk about those two options. But again, the last piece of it with the personal bank concept is bringing the banking piece in, the banking tool, and that's the line of credit. So whichever you have is the fixed or the growth policy, okay, you access funds from it using the line of credit. In most cases, and by the way, it's 3.95 interest. So if you're earning more than that in your policy, you now have a positive arbitrage, don't you? In other words, you can access and use those funds for other purposes and still earn interest on it. And here's something I'm going to say. For any of those of you who are listening, if you have a policy of any kind, whole life, IUL, universal, whatever, and your interest rate on your loan is higher than 3.95, you really need to contact us. Because at the very least, we'll look at your policy, we'll do a free comparison to see if we can do something better for you that can grow more with tax favor and all that good stuff. But at the very least, we can save you interest on your loan costs. If you're paying 5, 6, 7, I've seen 8% on some of these loans out there, and some folks are paying that right now, especially after COVID and all that. Some folks have had accessed funds and needed to, and they're paying far more interest than they need to. And we can show them how to reduce that interest cost, in many cases, dramatically. So again, if you have one of these policies and your interest rate on your loan is higher than 3.95, or you're considering it, contact us at yourpersonalbank.com. It's very simple to get qualified for one of these. Very simple underwriting on the line of credits. They're going, the collateral for the loan is the policy. The bank knows they're going to get their money back, basically. So it's a very low-risk loan for the bank, so it's very easy to qualify. Pretty much, for the most part, if you don't have judgments or tax liens, in most cases, you can get approved for these. I mean, that's pretty much how easy it is. And it's about a 1 or 2 page application. If it's a business or trust, there's a little bit more documentation, but it's, again, very simple, very easy. And last thing I say to folks is, look, if you've got one of these policies, and even if you don't see a current need for monies, apply for the line of credit and get it anyway set up. Why? There's no loan fees. And if you don't tap the line, there's no interest charge. So there's no cost for doing the line of credit. And I liked the previous show where we were interviewing Brandon Miller with M&M Bank, VP of equity line financing with his bank, which is their. He said, "What are you waiting for? If you got cash on a policy, you should set it up, because if you need it, you got it." Now, by the way, can you just go down to your neighborhood local bank or whatever and get one of these lines? The answer is probably not. Most banks, I can say that with certainty, are not set up to do these kinds of loans. It is a specialty in the banking industry, just like maximizing cash growth in a policy is a specialty in the insurance industry. Okay, so these are two specialized products that are designed, again, to work very specifically to grow cash, and then the line of credit designed to have the collateral being the policy. They work together extremely well. And by the way, this is a tool that's often used by institutional investors like banks and corporations, professionals, investors, business owners, the wealthy. Folks, this strategy has been around for decades and decades. This isn't new. It's just not commonly used or aware of to the general public, is what I find. And that's really, I guess, one of my main purposes of this show, is to educate people and help them understand that there just might be a better way to grow your money, and most importantly, have access to it and still grow your money. Folks have been doing this for a long time. There's no reason why you can't look at it and take advantage of it for yourself. And what that does is it can, over time, dramatically change and enhance your financial future. And that's what I get excited about when I talk to people and educate them about this tool. Contact us at yourpersonalbank.com. Go to the website. There's additional information on how this works. Contact us. Get more information. Let us educate you and look at your situation and see if your situation is a good fit. It often is. And how we can make things enhance your growth, enhance your access to your funds, reduce your income taxes, and most importantly, have your money grow even if you use it for other things. Stay tuned to the Your Personal Bank show, Tuesday at noon on Money Radio.
Listen next week at noon for more information on Your Personal Bank. Contact Ference at 866-515-6280 or online at yourpersonalbank.com.
This show is designed to provide accurate and authoritative information. The presenter and guests on this program do not engage in rendering legal, accounting, or tax advice. Expert advice from a professional involving your specific situation should be sought, if required. Permanent life insurance is a long-term investment. Products, optional features, and riders may have limitations, restrictions, and additional charges and may not be available in all states. Withdrawals beyond principal may be taxable income. Excessive and unpaid loans may cause the policy to lapse. If a policy lapses, unpaid loans are treated as distributions for tax purposes. Replacements may not be suitable for everyone. There may be penalties and surrender charges when replacing coverage. New products may include new surrender charges and contestability period. Policy guarantees are based upon the claims-paying ability of issuing insurance company and do not apply to the investment performance or assets in the underlying variable portfolios. The life insurance and annuity products in this presentation are not FDIC insured, may lose value, and are not bank guaranteed.